If you think this recent pullback in gold and silver is just random noise, or worse, the beginning of the end, you might be looking at the wrong thing entirely. Because the most dangerous moves in markets are not the explosive rallies or the sharp drops. They're the quiet pauses where positioning shifts under the surface while most people stop paying attention. And right now, that's exactly where we are. After a monster run, metals have cooled off, headlines are debating whether the momentum is fading, and investors are asking the same question again. Is this just a healthy reset, or is something breaking? Today is Thursday, February 19th in New York, and before we go deeper, I want you to comment the exact day and date you're watching from. Markets are time sensitive. Context matters. Now let's strip away the emotion and focus on the mechanics, because gold and silver do not move because they are supposed to. They move because capital moves. And capital moves based on incentives, risk, liquidity, and confidence. Over the last few years, one of the strongest forces shaping precious metals has been the tension between cooling inflation and still restrictive monetary policy. The most recent Consumer Price Index data shows headline inflation running in the mid-2% range year over year, with core inflation slightly higher. On paper, that looks calm compared to the peak inflation scare. But here is what actually matters. Inflation cooling is not the same thing as inflation being forgotten. Businesses still price cautiously. Workers still negotiate carefully. Policymakers still communicate with restraint. When inflation spikes once, it leaves a psychological imprint. That imprint lingers longer than the data suggests, so even as inflation moderates, trust does not fully return. And gold does not require panic to stay relevant. It only requires doubt. Now layer in the US dollar. Over the past stretch, we've heard a steady rhythm of commentary about dollar softness, especially after last year's rough performance and a weaker start this year. Surveys have shown large fund managers leaning heavily bearish on the currency. That matters because gold is priced globally in dollars. When the dollar weakens, gold can appear stronger, even if nothing else changes fundamentally. But the reverse is equally true. If the dollar strengthens for a few sessions, gold and silver can dip temporarily, even when the broader thesis remains intact. So when metals pull back, sometimes the explanation is not dramatic at all. Sometimes it's currency volatility creating short-term turbulence. The bigger question is whether the pullback is structural or simply mechanical. Here's where investors often fall into a trap. Metals surge, they stall, they dip, and immediately the internet demands a single explanation. It must be central bank politics. It must be geopolitical tension. It must be manipulation. It must be a bubble. But markets are not obligated to provide one clean narrative per candle. Markets are crowds. Crowds move unevenly. Some participants are hedging. Some are speculating. Some are rebalancing. Some are simply reacting emotionally. And afterward, everyone wants to pretend there was a single cause. This week's interview that triggered discussion made two core claims. First, that gold and silver ran hard, pulled back, and are now consolidating with no fundamental shift. Second, that the real risk may not be metals at all, but broader policy direction combined with the possibility that the artificial intelligence trade has inflated into a bubble capable of destabilizing equities. Both claims sound reasonable at first glance. But assumptions deserve inspection. Start with price structure. Gold pushed into the high 4,000s, approached the psychological barrier just below 5,000, and then retreated. Silver followed a similar arc, breaking to new highs before settling into a choppy band. But gold and silver are not single-layer markets, they are stacked systems. There is the physical coin and bar market where premiums, delivery times, and trust matter deeply. There is the futures market where leverage and hedging dominate. There are exchange-traded funds where flows can swing sharply with a single click. And then there is official sector demand, where central banks operate strategically, often quietly and patiently. When someone says gold moved, the real question is, which layer moved first? Sometimes the futures market gets crowded, and physical buyers step back. Sometimes the physical market tightens, and paper pricing catches up later. Sometimes ETF inflows create visible momentum that looks like a global awakening, but is largely capital reallocating between large funds. Recent World Gold Council commentary for January showed renewed global ETF inflows, pushing holdings and total assets higher again, with trading volume surging. That is not conspiracy. That is infrastructure. Modern capital moves quickly. Funds can take profits. They can rebalance exposure. They can rotate risk. None of that requires a crisis. But ETF flows also create feedback loops. Momentum attracts attention. Attention attracts capital. Capital reinforces momentum. And suddenly what began as positioning becomes a narrative. That dynamic matters during rallies and during pullbacks. Silver behaves even more dramatically. Its market is smaller and thinner. Marginal capital has amplified impact. When momentum traders enter silver, they often chase speed rather than long-term fundamentals. That is how you get weeks that feel like months. That is how price overshoots. And that is why consolidation often follows explosive runs. Silver pushing beyond prior ranges into triple-digit territory and then cooling into chop fits, historical behavior. But the critical question is whether consolidation is building a stronger base or quietly distributing into weaker hands. You cannot answer that with a screenshot. You watch how dips are handled. Recently, pullbacks have been bought, though with less urgency than the initial breakout. That is not necessarily bearish. It often signals transition from emotional buying to structured ownership. Structured ownership is more durable than speculative frenzy. Now consider fundamentals beyond price. Claiming nothing has changed ignores evolving geopolitical alignment. Official buyers think in terms of long-term risk management. Central bank gold purchases have remained historically elevated, with recent data indicating additions exceeding 800 tons last year. That persistent demand underpins the market differently than a decade ago. On silver, industrial demand has transformed the landscape. Instead of photography dominating, today silver is critical for solar panels, advanced electronics, grid infrastructure, and high-efficiency systems. Industry surveys have pointed to record industrial demand alongside ongoing supply deficits. That context matters. A deficit does not guarantee straight-line appreciation. Silver remains volatile. Positioning can overwhelm fundamentals temporarily. But when monetary perception and industrial necessity combine, the demand structure shifts. And when the United States Geological Survey includes silver on its critical minerals list because of its importance in electrical circuits, batteries, and solar applications, that reflects strategic acknowledgement. So the claim that fundamentals are frozen oversimplifies reality. Not everything changed overnight, but background conditions have been shifting steadily. And markets respond in waves, not straight lines. What looks like a pause may actually be preparation. Now let's push deeper, because price consolidation in metals does not exist in a vacuum. Even if you accept that gold and silver are simply digesting gains, the environment around them is anything but calm. Monetary policy remains tighter than many investors grew comfortable with during the era of ultra-easy liquidity. Yes, in late 2025, the Federal Reserve cut rates 3 times, but by late January it held the target range steady around 3.5% to 3.75%. That is not emergency easing. That is still restraint. And metals are extremely sensitive not just to where rates are, but to how investors perceive real rates, liquidity conditions, and the credibility of policymakers. When inflation data shows headline readings in the mid 2% range year over year, with core inflation slightly higher, it creates an illusion of stability. But policymakers remember the spike. Businesses remember the spike. Consumers remember the spike. That memory shapes behavior. So even as data improves, central banks communicate carefully. They avoid signaling premature victory. And markets interpret that caution as a sign that policy may remain restrictive longer than previously assumed. That interpretation matters for speculative assets, but it also matters for metals because gold and silver respond to expectations about real yields and liquidity. It's also not just about domestic rates. Since early 2025, tariffs and trade restrictions have reemerged as active economic tools. Official summaries have outlined actions and counteractions across multiple sectors. These are not theoretical adjustments. Tariffs influence corporate sourcing decisions, inventory management, and capital expenditure plans. When a company faces uncertain trade costs, it hesitates. When supply chains shift, pricing pressure shifts. That ripples through inflation expectations and growth projections, and those expectations ripple through safe haven demand. When someone says nothing fundamental has changed, that statement assumes fundamentals only shift when a single headline explodes. But fundamentals often move slowly. They are altered through policy adjustments, regulatory changes, and strategic decisions that accumulate over time. Tariffs expanding across 2025 and partner responses adjusting accordingly are not invisible forces. They alter incentives gradually, and markets respond gradually. Now zoom out to official sector behavior. Central banks have not stepped away from gold. Recent published data shows official buyers adding more than 800 tons over the past year. That level of sustained accumulation is historically significant. Central banks diversify reserves based on long-term strategic objectives, not weekly price swings. When they buy, they are thinking about currency exposure, geopolitical risk, and financial stability. That creates a baseline of demand beneath the market. Silver's industrial side reinforces the complexity. Industry survey figures have shown industrial demand hitting records again last year. Solar deployment, electrification initiatives, high-performance electronics, and data infrastructure expansion all require silver. At the same time, supply growth has lagged, resulting in multi-year deficits. A deficit does not automatically translate into immediate price appreciation. Silver remains volatile and can be pushed around by speculative flows. But a persistent imbalance between demand and supply creates structural pressure that can resurface once positioning clears. Silver's dual identity amplifies its volatility. It is perceived as a monetary metal, reacting to macroeconomic uncertainty, and as an industrial metal, responding to growth and infrastructure trends. When both narratives align, moves can become explosive. When narratives conflict, volatility intensifies. Recognition of silver's importance has expanded. The United States Geological Survey included silver on its critical minerals list due to its essential role in electrical circuits, batteries, and solar technology. That designation does not predict price, but it signals strategic awareness at the policy level. The interview also emphasized narrative risk, particularly around Federal Reserve leadership speculation and balance sheet reduction. Liquidity is often compared to oil in an engine. When liquidity is abundant, markets function smoothly. When liquidity tightens, friction increases. Discussions about shrinking balance sheets or maintaining restrictive stances influence investor psychology. Even if no dramatic action occurs, expectations of reduced liquidity can alter positioning. So if participants anticipate less liquidity, heightened political pressure, or continued trade friction, it is logical for metals to remain supported despite temporary corrections. A technical pullback does not equal structural weakness. It can represent repositioning. Imagine a crowded theater exit. When everyone moves at once, congestion forms. Movement pauses. Some step back. Flow reorganizes. Then motion resumes more evenly. Consolidation performs that function in markets. Mainstream coverage has acknowledged silver's link to electrification and supply constraints, solar capacity additions, grid upgrades, and advanced manufacturing demand physical inputs. Therefore, volatility following a surge should not surprise informed observers. Smaller markets adjust more violently to incremental capital. The broader policy environment adds another layer. Federal lobbying expenditures have climbed into the mid-$4 billion range according to recent annual data. That figure does not imply corruption or crisis. It reflects complexity. When policy becomes more intricate, influence becomes valuable. When influence becomes valuable, capital allocates toward shaping outcomes. Investors witnessing increased discretion in policy may seek assets perceived as less dependent on political negotiation. Gold and silver frequently re-enter the conversation during such periods, but nuance remains essential. Intervention is not monolithic. Some tariffs aim to de-risk supply chains. Some sanctions pursue strategic objectives. Some regulatory changes respond to domestic concerns. Markets evaluate direction, magnitude, and implementation. Reviews documenting tariff expansion through 2025 and corresponding responses show that policy adjustments are ongoing rather than static. Separate analyses of sanction usage illustrate evolving targets and strategies. The conclusion is not universal deterioration. It is sustained policy activity. Sustained activity creates uncertainty. Uncertainty elevates volatility. Volatility influences asset allocation decisions. Investors weigh growth prospects, inflation risks, and currency confidence simultaneously. Monetary credibility, regulatory simplicity, and trade predictability act as key dials. If markets believe inflation will be managed responsibly, that reduces panic. If regulatory overlap increases friction, investment slows. If trade expectations fluctuate frequently, supply chains become fragile. When those dials misalign, safe haven demand can strengthen. Therefore, consolidation in metals must be evaluated within this broader matrix. It is occurring while central bank demand remains elevated, industrial silver demand sets records, supply deficits persist, monetary policy stays comparatively restrictive, and trade measures continue evolving. That is not a static backdrop. It is dynamic. All of this sets the stage for the final major element raised in the interview, artificial intelligence. Because the AI trade does not float independently from liquidity, rates, and policy credibility, it is intertwined with the same conditions shaping metals. And understanding that interconnection is critical before drawing conclusions about the next phase for both precious metals and broader equity markets. Now we come to the part of this conversation that most people are either extremely excited about or quietly nervous about, and that is artificial intelligence. Because while metals have been consolidating, massive amounts of capital have been flowing into AI-related companies. The argument presented was clear. Valuations have stretched, expectations have accelerated, most new ventures will fail, and if enthusiasm fades, the broader market could feel the shock. There is logic in that caution. But like metals, the situation is more layered than a simple bubble headline. Artificial intelligence is not imaginary. Companies are building data centers. They are purchasing advanced chips. They are expanding power capacity. They are restructuring workflows. That is real capital expenditure. The danger does not lie in the technology itself. It lies in how that technology is priced relative to financing conditions and future assumptions. When investors justify high valuations by saying profits will come later, They are implicitly relying on favorable discount rates and abundant liquidity. Those assumptions depend on monetary policy. Even after the rate cuts in late 2025, policy has remained comparatively restrictive by recent historical standards. The Federal Reserve held the target range around 3.5% to 3.75% in late January. If inflation remains sticky, the bar for aggressive easing stays high. That matters because speculative sectors require time and capital. If money is cheap and plentiful, ambitious projects can survive long development cycles. If financing tightens, runway shortens quickly. That does not mean markets collapse simply because someone calls something a bubble. Markets correct when marginal buyers disappear. Marginal buyers vanish when liquidity contracts, earnings disappoint, regulation shifts, or unexpected shocks force selling. Many previous technology cycles followed that pattern. Enthusiasm surged, weak companies failed, strong companies consolidated power. Indexes often appeared stable even while individual names suffered steep declines. So acknowledging froth in AI does not equal predicting universal destruction. Where this connects back to gold and silver is through liquidity and currency confidence. The old assumption that metals always move opposite stocks does not always hold. In a liquidity-rich environment, investors can allocate to equities and metals simultaneously. If the concern is long-term purchasing power rather than short-term fear, capital may flow into technology stocks, gold and silver at the same time. There have been periods where tech valuations expanded while gold also gained attention. The common driver was currency skepticism rather than panic. Now bring this discussion back to practical decisions. The advice offered near the end of that interview centered on rebalancing portfolios. After a strong equity rally, many investors discover their stock exposure has grown beyond intended levels. Rebalancing is not a forecast of collapse, it is discipline. Think of a shopping cart that begins to tilt because one item becomes too heavy. Without adjustment, steering becomes unstable. Rebalancing redistributes weight and maintains alignment with risk tolerance. Allocations to gold and silver differ across individuals. Some investors prefer a small single-digit percentage in gold. Others hold low double-digit allocations. Silver is often treated as a smaller complement due to its higher volatility. There is no universal formula. The correct allocation depends on objectives, timeline, and comfort with fluctuations. What matters is clarity about risk exposure rather than chasing headlines. The interview also mentioned a concept of earning yield on gold instead of paying for storage. That idea can sound attractive, but yield does not materialize without structure. If gold generates a percentage return in metal terms, it is usually being leased or involved in a financing arrangement. That introduces counterparty risk. Contracts define redemption rights, collateral, and conditions during stress. The appealing phrase is paid in gold, but the critical question becomes whether access to the gold remains secure when markets tighten. Yield always originates from somewhere. Now step back and connect the entire landscape. Metals surged to new highs. They pulled back into consolidation. Central bank purchases exceeded 800 tons last year. Industrial silver demand reached records driven by electrification, solar installations, and data infrastructure. Supply deficits persisted for multiple years. The United States Geological Survey designated silver as a critical mineral due to its role in electrical circuits, batteries, and solar cells. The Federal Reserve cut rates 3 times in late 2025, yet maintained a target range around 3.5% to 3.75% in late January. Headline inflation cooled to the mid-2% range year over year, with core slightly higher. Tariffs expanded across 2025, with partner responses adjusting. Federal lobbying expenditures reached into the mid-$4 billion range. Artificial intelligence attracted substantial capital amid restrictive but easing policy. That is not a static environment. It is layered and dynamic. When consolidation occurs within such a context, it should be interpreted as information rather than noise. Observe who sells into rallies and who accumulates during weakness. Watch how volume responds to dips. Monitor policy credibility and liquidity signals. Markets rarely move in straight lines, especially when structural forces and narrative forces interact simultaneously. Volatility is the honest expectation. Silver's smaller market size means incremental capital can trigger outsized swings. Gold's broader liquidity dampens some moves, but does not eliminate them. Position sizing should reflect that reality. Confidence should not translate into overexposure. Risk management remains central. So on this Thursday, February 19th, the situation is not about a simple yes or no. It is about understanding that a pause does not automatically negate a thesis, and a rally does not guarantee permanence. The deeper forces shaping metals include strategic reserve diversification, industrial transformation, policy evolution, and liquidity cycles. The forces shaping equities include technological innovation, financing conditions, and investor psychology. 2 questions remain. Is this metals pullback merely preparation for another leg higher, or an early signal that easy momentum has faded? And regarding artificial intelligence, are we witnessing unsustainable exuberance or a messy but durable transformation where survivors strengthen over time? Your interpretation will influence your allocation decisions. Everything discussed here is for educational and general discussion purposes. Independent analysis matters. Personal financial circumstances differ. Consult qualified professionals when necessary. Uncertainty is not temporary. It is permanent. Managing exposure thoughtfully within that uncertainty is what ultimately separates disciplined investors from reactive participants.